Is keeping cash in the bank really the best option? Let's dive into this common financial belief. Many of us stash our hard-earned money in the bank, assuming it's the safest place. But is it? Really? I'm going to cover 6 assets that are all around better than cash. But first, let's quickly look at the drawbacks of cash, so we can see why it's not the best choice. First, let's talk about inflation. It's like a slow, stealthy thief, eroding the purchasing power of your cash over time. When inflation rates exceed the interest you earn, your money loses value in real terms. So, if you're hoarding cash in the bank, you might be losing money without even realizing it. Then there's the lost opportunity. Imagine your cash sitting idle in the bank doing nothing while you could be investing it into assets that generate income or grow in value. Every dollar you keep in the bank is a dollar that isn't working for you, creating wealth. So what's the alternative? Well, there are several assets out there that are both safer and better than cash. I'm going to cover 6 of them. Each of these assets has its unique advantages, which we'll explore in detail. But remember, while it's important to understand the drawbacks of keeping cash, it's equally essential to make informed financial decisions. Always consider your individual circumstances, financial goals, and risk tolerance before deciding where to put your money. Now let's dive into these assets and see how they stack up against cash. Let's kick off with our first asset, high-yield savings accounts. Consider high-yield savings accounts as a superior alternative to traditional savings. These accounts, as the name suggests, offer significantly higher interest rates than your average savings account. This means that your money isn't just lying dormant, it's actively growing. One of the key benefits of high-yield savings accounts is safety. Your money is insured just like other bank accounts, giving you peace of mind. It's also just as liquid as other bank accounts. You can access your money when you need it, making these accounts an excellent place to stash your emergency fund or save for short-term financial goals. The interest earnings from high-yield savings accounts are what truly sets them apart. Traditional savings accounts offer measly interest rates, nowhere near enough to keep up with inflation. But high-yield savings accounts? They offer interest rates that are often 20, 30, or even 40 times higher. This means that your money is not only safe but also growing at a faster pace. Consider high-yield accounts like Marcus by Goldman Sachs, Synchrony, and more. These financial institutions are well known for their high-yield savings accounts. But remember, while high-yield savings accounts offer better returns than traditional savings, they still can't outpace inflation in the long run. They're best used for short-term savings objectives or as a safety net, rather than a long-term investment strategy. All in all, high-yield savings accounts offer a combination of safety, liquidity, and better interest earnings. They're a step up from keeping your hard-earned cash under the mattress, or in a low-interest traditional savings account. So if you're exploring a place to park your cash where it can grow safely, consider high-yield savings accounts. They're a financially savvy choice for those looking to get more from their savings. Moving on to our second asset, certificates of deposit, more commonly referred to as CDs, come with a series of unique benefits of their own. Put simply, these are time deposits provided by banks and credit unions, featuring a fixed term that usually spans from 1 month to a maximum of 5 years. This means you agree to keep your money in the account, untouched, for the agreed-upon period of time. A distinguishing feature of CDs is their fixed interest rates. The moment you purchase a CD, you are aware of the exact interest rate you'll receive throughout the term. This offers a sense of stability and predictability which is rare to find in other investments. Regardless of the market, whether it's up or down, your CD keeps generating interest at a steady rate. Now let's discuss risk. CDs are viewed as a safe investment. The reason? They're insured by the Federal Deposit Insurance Corporation for banks, and by the National Credit Union Administration for credit unions, with coverage up to $250,000. This means that even if the financial institution fails, you won't lose your money. But what about wealth building? You might be thinking, sure, CDs are safe, but can they help build my wealth? The answer is yes, particularly if you employ a strategy known as CD laddering. CD laddering entails purchasing a number of CDs with varying maturity dates. This allows you to enjoy higher interest rates for longer terms while maintaining regular access to a part of your money as each CD matures. For instance, you might purchase a 1-year, a 2-year, and a 3-year CD. When the 1-year CD matures, you reinvest the money in a new 3-year CD. This way, you constantly have available funds, but you're still optimizing your interest rates. In conclusion, CDs offer a fixed return on investment, establishing them as a reliable and low-risk asset. They may not offer the high potential returns of riskier investments, but they offer a sense of stability and safety that can be a significant part of any diversified portfolio. Our third asset is U.S. Treasury Securities. These are another safe option to consider. Now, why are Treasury Securities considered so secure? Simply put, they are supported by the full faith and credit of the U.S. government, bringing a guarantee on the payment of interest and principal. This means that the risk is as low as you could hope for. There are various types of Treasury securities available, each having its own distinct features. Treasury bills, or T-bills, are short-term securities that mature anywhere from a few days to a year. These are sold at a discounted face value, and upon maturity, you receive the complete face value. On the other hand, Treasury notes, or T-notes, are medium-term securities maturing in 2, 3, 5, 7, or 10 years. They provide interest semi-annually and return the face value upon maturity. Lastly, we have Treasury bonds, or T-bonds, which are long-term securities with maturities of 20 or 30 years. Similar to T-notes, they also provide interest semi-annually and return the face value upon maturity. Now let's discuss yield and liquidity. Treasury securities propose competitive yields in comparison to other safe assets. The yield, or the return on your investment, depends on several factors, including the current interest rate environment and the length of the maturity. Liquidity is another key advantage of Treasury securities. They are highly marketable, meaning they can be easily bought and sold on the open market. This flexibility allows you to sell them before maturity if you need to access your money. In a nutshell, Treasury securities are a secure and consistent investment option. With a range of types available, they cater to different investment periods and risk profiles. Whether you are looking for short-term or long-term investments, Treasury securities provide a reliable method to increase your wealth, supported by the full faith and credit of the U.S. government. Our fourth asset today is dividend-paying stocks, often seen as a source of passive income. Dividend-paying stocks are equity ownerships in corporations that allocate a portion of their profit to stakeholders through dividends. Normally, these dividends are dispersed quarterly, biannually, or annually, offering a consistent flow of revenue to the stakeholders. This feature of persistent income generation is what distinguishes dividend-paying stocks from those not offering dividends. The best part is that these dividends are frequently reinvested back into purchasing additional shares, leading to the potential for exponential growth of your wealth and dividend income. Now, let's focus on the growth potential. Certain dividend-paying stocks not only ensure a regular income, but also have potential for capital appreciation. This means that the price of the stock may rise over time, resulting in increased overall return on investment. Consider an instance where you invest in a company that not only dispenses a healthy dividend, but also has a growing business model and strong financial health. Gradually, as the company's profits rise, so does its share price, and consequently, the value of your investment. But it's important to remember that not all dividend-paying stocks are identical. Some companies may appeal to you with high dividend yields, but their growth potential might be lower. Others may offer lower yields, but a greater possibility for capital appreciation. Therefore, it becomes imperative to conduct thorough research and understand the company's financial health, growth potential, and dividend history before investing. It's also crucial to remember that while dividend-paying stocks could be a lucrative investment, they are not free of risks. Market conditions, the financial health of the company, and economic factors can all influence the dividend payout and the price of the stock. So, what's the key takeaway? Investing in dividend-paying stocks can be a rewarding strategy, offering both income and potential growth. However, like any investment, it requires research, thought-out decision-making, and above all, patience. After all, wealth accumulation is a marathon, not a sprint. Before we move on, I would greatly appreciate it if you like this video and consider subscribing. I have many more epic finance videos on the way. Our fifth asset offers several advantages: real estate investments. Let's immerse ourselves in the fascinating realm of property and land. When you consider real estate, rental income is probably the first thing that comes to mind. Rental income ensures stable cash flow that often covers your investment costs and in many cases generates a significant profit. This income type tends to be more predictable compared to other investments, making it a preferred choice among many investors. However, rental income is just the tip of the iceberg. Real estate also has the potential for appreciation. As time passes, your property value might increase, leading to substantial gains when you decide to sell. Such appreciation can transform real estate into a potent tool for building wealth long-term. Keep in mind, location is a crucial factor in property appreciation, so performing due diligence before purchasing is important. You might be wondering, real estate seems like a lot of work. How about the maintenance, tenants, and paperwork? Well, there's an answer for that. Real estate investment trusts, or REITs, are that answer. REITs enable you to invest in real estate without the requirement to own, operate, or finance properties. Instead, you purchase shares in a trust that manages a property portfolio. This way you can experience the rewards of real estate investing, such as income and appreciation, while also enjoying the diversification that comes with investing in a range of properties. So whether you're renting out a second home, flipping houses, or buying shares in a REIT, real estate investing offers various ways to earn income and wealth. With their potential for steady income and long-term appreciation, they can be an excellent addition to your investment portfolio. But as always, it's crucial to do your research before taking the plunge. Consider your financial goals, your risk tolerance, and the amount of time and effort you're willing to commit to your investments. And always remember, a diversified portfolio is typically the safest bet. Our sixth asset class to consider is none other than precious metals, specifically gold and silver. These valuable commodities have been treasured by societies across the globe for thousands of years, not only for their beauty, but also for their unwavering value. One fundamental benefit of investing in precious metals is their ability to act as hedge against inflation. As inflation accelerates, the purchasing power of cash decreases. But gold and silver? Those assets continue to shine. In moments of economic instability, investors frequently gravitate towards these metals as a safe haven, causing their prices to escalate. This characteristic makes them an exceptional tool for wealth preservation during volatile times. Over the course of history, both gold and silver have demonstrated their reliability as stores of value. Unlike paper currency, these metals can't be mass-produced, and their availability isn't contingent on government policies. This limited supply contributes to their value. When you possess a gold or silver coin, you're in possession of an asset that has preserved its value for thousands of years. But how can you acquire gold and silver? There are two primary methods. The first is physical ownership. Yes, you can purchase actual gold bars or coins. However, this involves secure storage and the need for insurance, which can increase the total cost of ownership. The second method is through financial instruments like exchange-traded funds or ETFs. These funds mirror the price of gold and silver and can be traded like shares on an exchange. ETFs represent a method for gaining exposure to the price fluctuations of these metals without the necessity to physically store them. Similar to any other investment, it's crucial to conduct your research and understand the dynamics of the precious metals market prior to investing. In short, precious metals are valuable resources in the pursuit of financial stability and growth. Consider incorporating them into your diversified investment strategy. After all, a savvy investor never puts all their eggs in one basket. Speaking of diversification, it's important to diversify among these assets. Diversification is spreading your investments across different asset classes, be it high-yield savings accounts, certificates of deposit, Treasury Securities, dividend-paying stocks, real estate, precious metals, or others. You're effectively balancing your risk. If one asset underperforms, others might perform well, cushioning the overall impact on your portfolio. However, it's not just about spreading your money around. Your asset choices should align with your individual financial goals and risk tolerance. For example, if you're nearing retirement, you might want to lean towards lower-risk assets. On the other hand, if you're in your early working years, you may have the ability to take on more risk for potentially higher returns. Remember, diversification is key in managing risk and achieving your financial goals. Let's summarize the key points we've discussed today. We learned that inflation and missed opportunities can significantly erode the value of your cash over time. We covered 6 compelling alternatives to cash, each with its own merits. High-yield savings accounts provide a safe haven for your money while generating better interest. Certificates of deposit offer fixed interest rates over a set period. U.S. Treasury Securities are a reliable asset backed by the U.S. government. Dividend-paying stocks are another intriguing alternative, offering both passive income and potential for capital appreciation. Real estate can provide a stable source of rental income and potential appreciation over time. And let's not forget precious metals like gold and silver, which are historical stores of value that can act as a hedge against inflation. These are all great options for avoiding the pitfalls of cash, but remember that diversification is key. Spreading your investments across different asset classes can help balance risk and reward. Finally, seeking guidance from a financial advisor could be a valuable step in aligning your investments with your personal goals. They can provide personalized advice based on your unique financial situation and help you navigate the complex world of finance.